Hello, I'm Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We're here every Sunday, 6 a.m. and 8:30 a.m. And of course, make sure you go to my website, reznywealth.com. I also do a live 2-hour radio show throughout Florida every Sunday morning from 10 a.m. to noon. If you go to my website, reznywealth.com, we have a whole bunch of great information and free reports. Reports like how to avoid outliving your money during retirement, how to prosper in any economy, how to avoid the biggest risk you, the investor, has, which is fiduciary versus suitability, or better yet, how to understand if you have a real advisor or really just somebody selling you products that are better for their firm than for your retirement. Again, go to reznywealth.com. We will be taking your calls, your questions, and of course, we love to give you great answers so you can make better financial decisions. Our show is all about you, the listener, to make sure that you are doing the right things with your money. So anytime you want to send me a question, send it to Brian Rezny at reznywealth.com. You can also visit my website. There's a question box. You can click in a question. We would be more than happy to answer your question and get you the right information you need. You know, today I want to talk a little bit about the economy, of course. You know, we are obviously past first quarter of 2015. I'm happy to say our clients at Rezny Wealth Management had a fabulous first quarter of 2015, even though the stock market generally was pretty flat or up about 0.5%. One of the areas that I think is extremely important that investors look at is called alpha and beta strategies. These are strategies that often can outperform some of the base indexes because of the weightings of them without any more volatility. But what I find is about 9 out of 10 people, or less than 1 out of 10 individuals, actually utilize beta or alpha strategies in their portfolio. Why is that? Because they're traditionally working with a bank or a brokerage firm who's really just selling their house brand mutual funds, which unfortunately most mutual funds severely underperform even the base index of the S&P over not only short-term but long-term periods of time. Utilize ETFs, exchange traded funds, because ultimately they're better tools in the toolbox for your portfolio, and you can utilize beta and alpha strategies if you're trying to make a return on your money. And there's also strategies within ETFs that can give you a chance to reduce portfolio risk. Too often, too many investors become complacent, they don't run an investment strategy, and they don't have risk management in play when that next recession comes about. I firmly believe as a firm and as a money manager, risk management is extremely important in your portfolio. While our current indicators do not signal any sort of recession, at least over the next 3, 6, or 12 months, I firmly believe that as the economy expands, there's always an opportunity for a big contraction. If you're left unguarded without risk management, you're going to be in the same boat you were in 2008, and your broker is going to tell you, hold on, things will come back. That was exactly the wrong strategy then, and it's still the wrong strategy now. I want to talk about some of the investments you, the investor, often are sold by brokerage firms, banks, and insurance companies. These are investments you need to avoid. What I'd like you to do is, if you get a chance later, pull up your brokerage statement. If you own any of these investments in your portfolio, these are on my hit list of some of the worst investments you, the investor, could ever be sold. And I'm using the word sold because remember, your brokerage job or your so-called advisor from the bank or Wall Street firm is really a salesman, not a money manager at all. These investments you want to avoid, otherwise it could be very detrimental to your portfolio, your retirement, and your return. Let's talk about the first couple, annuities. Brokerage firms and banks love to sell annuities because it lines their pocket more than yours. My joke I always tell people is there's only 2 reasons you would want to buy an annuity. One is to insanely lock your money up for surrender penalties that often last 9 to 22 years in length, and to make the broker more money than you want to make yourself. Annuities are ladled with cost and penalties. There is really no reason why an investor would ever want to buy an annuity if they really did their research. The problem is the person that you're relying on to do the research is really a salesman selling you an expensive, inferior annuity when other investments would be far superior for your portfolio with less expenses. The problem is, remember, your broker, so-called advisor, the person at the bank or the annuity salesperson is working under suitability and doesn't legally work for you. I know that may be a shock to a lot of my TV listeners, but at the end of the day, less than 10% of firms nationally are fee-only fiduciary firms. As a fiduciary, that advisor, like my firm, would have to work for the client in their best interest. 90% of all these other firms often work under called suitability. They don't legally work for you. The brokers work for the brokerage firm or bank, and they can sell you inferior and expensive investments like annuities that ultimately rob your return. Let me give you one reason why annuities are toxic and dangerous to your wealth. The typical variable annuity that we've reviewed at our office, and we've done a lot of homework on these, typically run about 4.5% a year of annual expenses against your return. So if you own a variable annuity and your return is 7% for the year and your expenses are 4.5%, do the math. You're left making what? 2.5% on your money. So the reason your annuity never did that well is the expenses are so high to pay the lavish fees and commissions to the brokerage firm or the insurance company or bank. You're again left with mediocre returns, yet you're still taking the risk often of the stock market or the bond market or any asset they have you invested in. Avoid annuities. If you'd like, go to my website, reznywealth.com, download for free why annuities are dangerous to your wealth and retirement. There's a little more detail about why annuities are dangerous. Avoid annuities, and better yet, don't get suckered into going to the free steak dinner seminar where you're going to be pushed an annuity, an inferior investment for your retirement. Non-traded REITs, real estate investment trust. Non-traded REITs or real estate investment trusts are sold by brokerage firms. And again, why do they sell them to you, the investor? To make themselves more money. Let me give you a couple reasons why non-traded REITs never belong in your portfolio. First off, when you buy a non-traded REIT, about 20% of your initial money is taken off the top, stolen from you to pay for commissions and underwriting fees, 20%. I'll put it in layman's terms. If you invested $100,000 into a non-traded REIT, only about $80,000 of your hard-earned money would actually go to work. Right off the get-go, you lost 20% of your money. Number two, if that investment goes south, which a lot of these non-traded REITs do very bad performance or go down in value, they're non-traded. You can't get out of the investment. So once you're in, you're stuck in often for 5, 10, 20-year time frames until the REIT manufacturer decides they want to sell and return your capital, and who knows what you're going to get. Brokers love to sell non-traded REITs because it makes them more money and you less. Alternative investments, hedge funds, commodity funds. These are also toxic. And again, Wall Street loves to manufacture complex products that they then sell to you. A lot of these hedge funds and commodity funds, or alternative funds as they call them, these long short funds, are again illiquid investments, and it's hard to get your money back. Also, many of these funds carry stiff annual expense ratios that come against your money, often approaching 4% a year or more. So again, if your portfolio makes 7% and there's a 4% expense ratio against your return, you only made 3%. I've looked at a lot of these hedge funds, either publicly traded or non-traded, and if you look at the returns of the last 5 years, they are pathetic. Many of them have lost money in 5 years when the market's up and the bond market's up, or they've made substandard returns. So again, don't buy an alternative investment, a commodity fund, a hedge fund. Don't buy anything that doesn't have liquidity. It's great for your broker and his firm, but it's bad for your portfolio. I'm going to go to the phone lines and take your questions. If you have a question, send it to Brian Rezny at reznywealth.com. And again, once we receive your call or question, we will then answer it on my TV show. Make sure you do visit our website, reznywealth.com. You can download any of our free reports and learn more about investment pitfalls you need to avoid, and especially watch out for Wall Street and annuity salespeople. They are dangerous to your retirement. Larry from Boca Raton, Florida. Are mortgage REITs the way to go for high income, something like REM? Great question, Larry. Mortgage REITs are basically, an REM is an ETF. It actually buys a basket of stocks that are in the mortgage business. And what a mortgage REIT essentially does is they basically buy pools of mortgages. They borrow more money to buy more of these assets, so it's a levered portfolio. And they pay pretty high distribution rates or interest, usually approaching 10 or 12%. The problem is anytime you have these very high distribution or interest rates that you're being paid something like REM, it comes against really the principal. That particular investment in a lot of these mortgage REIT companies have not done that well. They've had 30, 40, 50% drawdowns in the value of their stock price. They've come back, they've gone down. The bottom line is with an interest rate environment as low as it is today, and if rates start moving up, mortgage REITs and investments in mortgage REITs are really going to get hurt. I would avoid REM. It's extremely risky. I know that dividend or interest payment looks compelling, but if you lose 20% of your principal and you get a 12% dividend stream, your total return is negative 8%. These stocks could perform extremely poor when rates essentially start moving up. And if you listen to our Fed president, she's basically stated sometime this year, if the economy keeps on track, they're looking to start raising rates up. It's going to hurt those investments. I would avoid it. Ted from Miami, Florida. Is 30% in bonds too conservative at age 29? Ted, great question. First off, the reason you own bonds in a portfolio is a portfolio buffer for short-term volatility because you're a little more conservative or you need current income. If you're 29 years old and you don't need current income, I think having any money currently in bonds is a big mistake. But if you're going to own bonds to reduce some of the volatility of your portfolio, own short-term bonds or bond funds, typically 3-year maturity or less. Do not stretch out and go to 5 and 10 and 15-year maturity bonds because the longer the maturity, the more volatility and loss you will receive when rates go up. Remember, when interest rates go up, bond values go down. We're about 2% on the 10-year Treasury. Rates could potentially go down some, but in my personal opinion, if you look at how the economy is doing and expanding, we have a much bigger chance for rates to move up, meaning bond investors will ultimately be big losers if rates go up, big losers, and the longer the maturity of bond you buy to get a little extra interest, you'll even be a bigger loser because the value drops even more in a rising interest rate environment. Carrie from Miami, Florida. My wife and I were sold 4 different fixed equity index annuities with income rider bonuses. The advisor who sold these to us says he wants to replace them with 2 better products his firm offers in real estate trusts. What do you think? Bottom line is this: you should have never been sold those annuities in the first place. If, Carrie, you would have done your homework, you would have realized annuities are no good for your money. No good. Now what that broker is, he wants to basically get rid of those annuities and put you either in different annuities or non-traded REITs. You're going to have another huge mistake. The first question I would ask you is, how much surrender penalty do you still have in those annuities? If you bought them 3 or 4 years ago, you could still have surrender penalties to get your money out 4, 5, 6, 10%, depending on which annuities you were sold. So he loaded you up in one annuity, or 4 annuities, excuse me. He wants to reload you in some other annuities with more surrender penalties. I would suggest you fire that person, find yourself a fee-only fiduciary money management firm like my firm, Rezny Wealth Management. If you want to learn more about why annuities are dangerous to your wealth and retirement, go to my website, reznywealth.com, and download any of our free reports. I would also suggest you download How to Avoid Outliving Your Money During Retirement. It's another great report. It's groundbreaking. It's perfect for pre-retirees and retirees alike. If you're trying to increase your retirement income and protect your money, download that free report. It'll talk about the major investment pitfalls surrounding retirees and pre-retirees that really devastate your overall portfolio and your return. Annuities and non-traded REITs, 2 toxic investments you need to avoid. I'm going to go to a quick break. I'll be right back with more questions after this. Hello, this is Brian Rezny. If your goals are to increase your retirement income and retire without stress, go to my website and download our groundbreaking free report. This free report covers the investment and retirement pitfalls that are often overlooked even by the smartest investor. If you're concerned about outliving your money during retirement, or maybe you want to make sure you're not leaving money on the table, this free report is for you. Know the facts. Your retirement depends on it. Go to my website, reznywealth.com, and download your free report right now. And we're back, and I hope you're enjoying today's program. Of course, if you have any questions, whether it's about stocks, bonds, mutual funds, investments you own, maybe you don't understand, or you need help with income, growing your portfolio, or protecting your portfolio, send your questions to Brian Rezny at reznywealth.com. Better yet, go to my website, reznywealth.com, or call my firm for a consultation. If you are concerned about your portfolio, if you're concerned about the advice you're receiving, if you're not happy with the returns you've made, or you've suffered big losses, and you want a better plan, call my firm for a consultation. It doesn't hurt to talk and get a second opinion. Let's go to Glenn in Fort Myers, Florida. I have been holding some floating rate funds as interest rate hedge, but can you guess how it's been going of late? What is your opinion? Bottom line is this, Glenn. Interest rate sensitive funds like floating rate funds or bank loan funds is probably more your question. If you own any of these, they either come in ETF format, exchange traded funds, or they come in a mutual fund format. When you buy floating rate funds, all that means is the interest rate floats, and which is actually good. When you're in a low interest rate environment, you want a bond fund that has the ability to float the interest rate. They're usually very short-term in nature, usually 90-day paper. It gives you the ability, if rates move up, you can correspondingly move up along with it. It floats, and it doesn't give you the hard downward pressure on the valuation of your bond portfolio because the interest rates float, and it's a very short maturity. We like floating rate securities in this environment. They're not all made the same. Do your homework. But if you're going to look at floating rate funds, look at ETFs, exchange traded funds. There's a few different ones out there. I think ETFs are a very good tool for investors who are concerned about interest rates. They want to invest in bonds. Floating rate securities might be the answer for part of your portfolio. Ken in Chicago, Illinois. Is Europe the place to be in 2015? What are your recommendations? Actually, Ken, I think Europe is coming back alive a little bit. So the bottom line is this. While I don't think Europe's going to be a long-term growth story like the U.S., I think the U.S. has many, many more decades ahead of us of technology, growth, all our hard work that goes on at the U.S. or in the U.S. I think is going to be beneficial to the valuations of stocks and investments in the U.S. And I think, generally speaking, a lot of areas of our economy will outperform Europe. The problem with Europe is it is extremely, extremely mature. It's also kind of spread the money out to everybody. I know people talk about the U.S. spread the wealth. It's been spread the wealth in Europe for years and years and years. There's not a lot of growth. There's a lot of debt. I don't think there's a lot of great opportunity. Europe's done well so far in 2015. Really, one big reason, because of the euro going down in value, has helped their stock prices basically go up. If you do invest in Europe, remember, it's going to be more of a short-term investment, 3 to 6 months, maybe a year, but there's going to be a point where Europe now is kind of fully valued. It'll probably get overvalued before it comes back down. I'm just not a big believer in Europe, and I think there's many better places in the U.S. currently to invest your capital and have a better chance for a return of your money and a return on your money. Carrie and Todd, Fort Myers, Florida. We are concerned after hearing your show last week. Help. Our advisor suggested Security Benefit Life and Allianz annuities for our 401k plan rollover. He said we would get a bonus on deposits and 6 and 8% returns. Carrie and Todd, basically you have a annuity salesman trying to sell you two different equity index or hybrid annuities as they're called. I would not buy any equity index annuity, and I wouldn't buy those ones either. The bottom line is this: anybody who's telling you to put all your money into an annuity is a salesman, is the bottom line. That person does not work for you. They work under suitability. I would suggest you go to my website, download my free report, Why Annuities Are Dangerous to Your Wealth and Retirement. I'll tell you this, statistically, over 50% of the people that come in and interview my firm or call our offices have been sold 1 to 4 different annuities. I haven't yet to see somebody that's been happy after they've been into these things for a couple years. Annuities, in my opinion, are toxic to your wealth. The only reason insurance agents and brokers sell them is because of the lavish commissions they pay them. They're going to make more money than you're going to make, and you're going to insanely lock your money up with big surrender penalties. Do not do it. By the way, those bonuses he touted, there's no free money in any of these annuities. If you do decide to take the bonus, most of these annuity companies actually have an annual charge against your money for the bonus you receive. So that free money is never free money. If they tout 6% or 8% returns, it's not on your real money, it's on this hypothetical pot of money, and the only way to get it is take an income out of it, usually annuitized or income for life, and often at substandard rates. So there's no free money in annuity, there's no free bonuses, and there's never 8% returns. It's called deceptive sales tactics or blatant lies by the annuity salesperson. Buyer beware. Call my firm for consultation. Big difference. Hire a fiduciary money manager like us. Don't hire Wall Street, annuity salespeople, or somebody trying to take your hard-earned dollars and lock it up with insane surrender penalties. Sal from West Palm, Florida. My advisor has me in the Hatteras Alpha Hedge Strategy C APHCX. The last 3 years, and it hasn't done anything. He tells me I should stay in. What are your thoughts? Sal, I'll tell you what. We get probably on a monthly basis 2-3 people that will call us that own hedge funds like the Hatteras Fund. If you look at the track record of that fund, it's pretty lousy. If you look at the expense ratio, it's sky high. Sky high expenses and mediocre performance give Sal what? Less money. Your broker wants to keep you into it probably because he gets a huge trail commission by keeping you in these funds. I would fire your broker, find yourself a feeling fiduciary money manager, and move on with your life and have a better chance to make a return on your money and get rid of the crazy fees associated with hedge funds and investments like that. Joe from Davie, Florida. What do you think of target date funds? Joe, that's a great question, and I get a lot of questions on target date funds. Basically, all a target date fund is a mutual fund family that, let's say, has 30 or 40 mutual funds, basically does an allocation with their own funds in this target date fund. So as an example, target date means you're 50 years old, you're going to retire at 65. You might buy a target date fund that matures or basically is designed to balance the portfolio for somebody who's going to have 15 years before retirement. The problem is I don't believe in the allocation they do in these funds, and they're using all their own same funds. A lot of them tend to be very mediocre. What you should do is do your own allocation, less in bonds, more in things that have a chance to have total return, growth of principal, and dividend. That's your best shot to combat inflation, grow your portfolio for retirement. And again, if you're 50 years old, if you're 65, you're 75, you're still a long-term investor with some of your money because you need income and future growth to provide income in your portfolio. Too often I find retirees think, hey, Brian, I'm 70. I'm not a long-term investor. But what they fail to realize, there's about a 90% chance of a husband and wife, one of you, living into your 90s. You need to grow some of that money, otherwise you're not going to have income when you need it. If you're too conservative, which I find a lot of retirees are too conservative with their money, you're not going to make a return, you're going to spend on principal, and unfortunately, that's not going to be good for your retirement overall. Larry in Naples, Florida. PIMCO Total Return Fund, what are your thoughts? Good fund, not great. I wouldn't buy it. I would look at some ETFs, exchange-traded funds, something like the AGG, fair disclosure, we own that. That's aggregate bonds. The PIMCO Total Return Fund, I think its heyday is done. It's a huge fund. In fact, it's still one of the largest bond funds out there. Bill Gross left the firm 9 months ago or so. Just because he left, it doesn't mean that's a reason to sell the fund. The reason I would not own the fund, it's too big. The bigger these funds get, what you often find is the performance starts to lag because it's hard to move a battleship. So the main reason I would not own that fund is because it's too big and cumbersome. There's either other smaller mutual funds with less money under management that can be more nimble and I think ultimately give you a chance for a better return, or ETFs, exchange traded funds with much lesser expense ratio that can be in areas like the aggregate bond AGG. In fact, the aggregate bond, which we own in a lot of our income portfolios, has done pretty darn well, not only the last year, but over the last 3, 5, and 10 years. Well diversified, low expenses, and I think that bodes well for your portfolio. Fred in Naples, Florida. My advisor is suggesting I move my variable annuity to a hybrid equity index annuity. What are your thoughts? I'm 68. Fred, don't do it. Your broker is taking out one annuity, and I had a question like this earlier in the show, and putting you and reloading you into a whole nother annuity. At 68, you should never buy any investment that has back and surrenders, and you certainly shouldn't be doing it at 68. Your broker wants to sell you to basically earn a commission to pay his house payment or car payment. That's not what you intended. Your goal is to make a return on your money within your risk profile. Going from one annuity to the next is just going to insanely lock your money up again with crazy expense ratios that basically, again, take away from your return. I would suggest, like I did my last 2 questions, go to my website, reznywealth.com, download for free Why Annuities Are Dangerous to Your Wealth and Retirement. By the way, when you are at my website, there are other free reports. One of the other one that is highly downloaded, perfect for retirees, is how to avoid outliving your money during retirement. It talks about the pitfalls of not properly investing your money, taking too conservative of a stance, which I'm finding a lot of retirees are doing today. They're being too conservative. You don't have to shoot for the stars, but you have to make a reasonable growth, total return, dividend, and interest in order to grow your money past inflation and taxes. Remember, if you're 70 years old, you could be around easily another 20 years. Inflation will hurt your returns if you don't make an adequate return on your money. Folks, I'm just about out of time. If you're concerned about your wealth, do you have financial concerns? Are you happy with your advisory relationship? Call my firm, get a second opinion. We always like talking to investors. We like to help you out. Call my firm right now, schedule a consultation. You'll learn a lot, and hopefully you'll benefit a lot from our conversation. Go to my website, reznywealth.com, download any of our free reports, and make sure you listen to my live radio show, 10 a.m. to noon throughout Florida. We'll see you next week.